Hola mi gente, welcome back to the channel. My name's Sean and this is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, I want to go over some very important information regarding the stock market. I think there's going to be a lot of things you can take away from this video that might help you better understand what's happening in the market and what could you potentially expect in the upcoming months, maybe even in the upcoming year. Today's video, we are going to be going into what I believe is an inevitable recession. We might already be in one. There's a good chance we're already in one. And I don't want that to be all doom and gloom, but I want to go over what to expect so that we can properly prepare ourselves to try to get in at a really good price, maybe even time that bottom that is so hard to predict. In this video, I'm not going to give you a definite answer on where the bottom is, but I'm going to give you some things to look forward to. Keep an eye on these metrics and use these metrics to help try to estimate where the potential bottom is or where good levels of entry would be. Because it is very hard to determine when is a good time to buy stocks when it seems like every day, every week, they just keep on falling, and you don't want to try to catch a falling knife. So you got to be very strategic here. You got to identify key levels based on fundamentals and technicals that make sense for your investing or trading goal. Depending on how long you want to be in the market, you can be a little bit more flexible. If you don't want to be in the market for very long, well, then you need to be way more precise. Now, I don't want to brag, but we made a lot of videos regarding this potential decline and some of the flashing warnings we saw. I made a video back in June of 2021 that was titled that the government just guaranteed inflation. Some of the flashing warnings that we all saw was that huge stimulus package right at the end of the pandemic, where it seems like we were getting out of the hole, the light was right in front of us. They decided to pump the economy with more money. That was a little bit too much and it was completely unnecessary. They also passed a multi-trillion-dollar infrastructure package, more stimulus, more government money. The Fed had to print more money out of thin air, decreasing your buying power. We also had that advanced child tax credits, and this came out when we were seeing more than 5% inflation. Now keep in mind that the Federal Reserve's target for inflation is 2%. So when they released this advanced tax credit, we were more than double the Fed's target for inflation. Now we're close to 9%. We also, and this is still happening, we have student loan payment pause and they're flirting with potential cancellation, and they have been canceling student loans for a certain amount of people depending on some criteria. But they're thinking about a broad cancellation of $10,000. That is more stimulus, that is going to lead to more inflation, and the fact the student loan payments are still paused when we're seeing with this level, when we're witnessing this level of inflation with unemployment at low levels, it is just inflationary and the administration is doing nothing. We've also saw some Fed policy errors, and these were big mistakes. The quantitative easing, or the QE, took too long and it was way too big. Then they waited forever to start quantitative tightening, QT, which we're starting now and we're tapering up, but it took way too long to start, and this taper to get up to where they need to be is worthless. It's just making matters worse. Get to where they need to be quicker and faster so they can deal with inflation. That's not what this Federal Reserve is doing. Now, it seems very likely that we're going to be heading into a recession. Probabilities keep on climbing as we get more economic signals. I posted a video in February of this year calling out some economic signals and pointing you towards some signals to watch to indicate a potential recession. Well, these signals keep on getting worse and worse, and yes, they are indicating that a recession is very likely. The first economic signal, and still want to watch this, is yield curve inversion. In particular, the 2-year compared to the 10-year. And we had that yield curve inversion happened more than once since I made this video. We also can take a look at consumer sentiment survey because if the consumer is not spending, if they cannot afford to spend money on goods, that is what causes a recession. So, seeing consumer sentiment survey numbers come really down and they have dropped a ton, that is also a huge indicator that we're maybe already in a recession. The next one is inflation. As inflation gets higher and higher, it becomes harder for people to buy goods if they have to spend so much money on gas and groceries. And inflation is through the roof. Another one is crude oil futures. For the prior recessions, we have seen crude oil futures hit very high levels. We are seeing high levels yet again, another indicator of a potential recession. And then the next indicator is the HYG. This is an ETF that follows junk bonds from corporations, and we are seeing a massive sell off in that. Investors and traders are saying that there's a good chance that companies are not going to be able to pay off these junk bonds, and that is why you are seeing a huge decline in the HYG. Now, the technical definition of a recession is 2 quarters of negative GDP growth. We got 1 quarter, we might get another, who knows? But GDP growth might be very misleading because with higher inflation, that means goods cost more. That means more gross domestic product. But if the consumer is getting more and more strapped and they are leading into more debt and more credit, then that's not a healthy economy. And that it could be a sign that we would get a recession later down in the road, but it's going to be way worse. So it's important to see what the consumer is doing. Are they putting everything on credit cards? How strong is the consumer and what is their sentiment? Now, a depression, and I'm not saying that we're going to get in one, but I want to show you how it could easily happen in this market. And that's not to scare you, but it is a realm of possibility considering how bad things are becoming with inflation. So, a depression is technically classified as a drop in GDP of at least 10%. Now, I want to show you this graph because this environment that we are in is very unique and it's almost eye opening. So, in 2021, the US GDP was $23 trillion. A depression, a 10% drop, would put us at a GDP of 20.7 trillion. GDP in 2018 was 20.6 trillion. GDP in 2019 was 21.4 trillion. But remember, we've been in a very low rate environment for a long time. We've had those corporate tax rates during the Trump administration that helped with GDP. So, for us to get into a recession, we would have to get back to 2018 levels. The reason why that seems very possible is because all of the fake money that was printed that is boosting or boosted GDP that is being taken out of the system right now, with the Federal Reserve increasing rates and letting bonds roll off their balance sheet. With the quantitative tightening, they are taking money out of the market in billions, billions, billions of dollars every single month. That is the goal. So that could easily put us into a situation where GDP starts to fall, and 10%, going back to 2018 levels, doesn't seem that crazy considering all of the fugazi money that we've had printed. Now, I personally do not think that we're going to get to those levels now, but it's something that could happen, and I'm going to keep an eye on, that's for sure. Because if we see words of a depression, if we hit that technically, even though we're only going back to 2018 levels, that is going to put a lot of fear in the market and really impact investors and traders psychologically. So that's a little bit of a backdrop. Let's talk about how this actually impacts the markets and what do we need to look at and what can we prepare for and how can we better take advantage of this situation. So there are just a few things here, basic things that basically govern the market, in my personal opinion. So the first one is the price to earnings ratio, and this is classified as a company's share price to its earnings per share. There are two factors there, two variables: share price and EPS, earnings per share. The next one is interest rates and how that impacts the price to earnings ratio, or what investors are willing to pay. What's a fair PE considering the interest rates? And then the next one is inflation and how that impacts EPS. But basically, what we're looking at for a few corporations, Target in particular, they reported a first quarter EPS of $2.16, which was a decrease of 48.2% from $4.17 in 2021. It's all that fugazi money. Valuations got so high, they were justified because these companies were making a ton of money because all that extra money floating around. Now that that money is being taken out, we're seeing a huge drop in profitability in EPS because also we're seeing huge inflation. So it's a double whammy here, and that's how you can see EPS drop by more than 40%. Now, we talked about how interest rates can impact the market, and this chart does a great job explaining this. What you're looking at is the interest rate for the 10-year, that's the orange line, versus the price to earnings ratio for the S&P 500. Now, if you compare the price to earnings ratio of the S&P 500, let's say we look at the 1980s, where the 10-year was around 14%. Well, with that rate being so high, that's more competition for stocks. That means people are willing to pay less for stocks, so your price to earnings ratio drops, and that's why we were below 10. In the 1990s, we start to see a decrease in the 10-year yield, and stocks move higher. Now, the estimate is that the 10-year can get to 4%. If it goes higher, then numbers are going to have to be revised. But it seems like major banks on Wall Street think around 4% is realistic. And if you look at 4% and you draw a straight line on the S&P 500 ratio, it seems like a fair value or a fair multiple would be a PE of 15. So right now, that seems to be the number that a lot of banks are thinking in terms of where fair value is for the S&P 500 and for the overall market. If the 10-year goes above 4%, keeps on going higher, then those numbers are obviously going to have to be readjusted and the PE is going to be lower, and that's going to hurt stocks. So now that we have our multiple figured out, which is around a 15, the next big portion of the equation is earnings. So here's our S&P 500 earnings estimate, and we can see that in 2020 we hit $207.45. We haven't really pulled back yet, and I think we're due for a pullback. I think earnings are being hit because of inflation. So here we go. Here are some estimates for S&P 500 earnings. We have an estimate in 2022 of $225. Now, let's do some scenarios here, and I think this is what's most important, right? We need to make these numbers or play these numbers out, and we need to keep an eye on earnings for major companies of the S&P 500, because if earnings are being reduced, like Target at 40-something%, then we could see a huge drop in S&P 500 earnings, and that means we're going to see a huge drop in the S&P to get to that multiple. Because remember, if our price to earnings ratio is 15, the equation to get to 15 is share price divided by earnings. So if earnings drop, then share prices need to drop with it to maintain that ratio of 15. So if earnings are 225 as estimated here, which hasn't really been revised due to this very high inflation, and we peg a 15 multiple to that, we're looking at fair value of the S&P at $3,375. Say $3,400, that's around a 30% drop peak to trough. If we revise earnings by 10% and get to $202.50 for the S&P 500, that puts our price of the S&P at $3,000, and that's a 37% drop. If we reduce earnings by 15%, that's $191.25. That puts our price of the S&P 500 at $2,868. and that's a 40% drop, and a 20% reduction would lead to a price on the S&P 500 of 27, a 44% drop. The key takeaway here is that earnings are key. If Target dropping 40 something percent because of inflation and inventory issues is any indicator of what's going to happen with other companies, then yes, maybe a 10% or 15% or 20% reduction in earnings is possible. And if we see that, we can see the S&P 500 drop more than 40% off of its highs. Now, in addition to that, if we take a look at the S&P 500's prior performance during recessions, how much did stocks drop or how much did the S&P 500 drop? We can see that down draws have ranged from 14 to 57%, and the average drop has been 32%. So with that being said, if we were to experience the average drop on the S&P 500 and using that 15 price to earnings multiple, that would mean that earnings would need to be around $225. So there's no revision to that estimate. So inflation is not really reducing earnings and we're still seeing an earnings growth. That would put us at $3,400. That's the average. But we could see far less numbers if we actually start to see earnings decline. And that is why earnings are so important and we need to see what companies are reporting. Now, there are a few technical levels that are of importance as well. That $3,400 price target of the S&P 500, which would be a 30% drop peak to trough, would put us right back at pre-pandemic levels. So that's a nice support. Maybe traders start coming in and investors start coming in at that point and saying, yes, it's worth the risk to reward ratio, even if there is some more potential downside. If we get to 3,000 on the S&P, then we have multiple levels of support here. Prior resistance turns into future support. So that's another key level as well. And then we can see that the other levels are also marked here with red horizontal lines. And there is some support and resistance at those levels as well. So technically, I can see a reason why all of these levels would work. I could see a reason, a very strong reason, why we would see a bounce at $3,400, a short-term bounce. Don't know if it's going to hold. I can see the same thing happening at 3,000. The most important thing is earnings, and we had some outlook on earnings for quarter one. But let's see what happens in quarter two. Now, we're looking at the S&P 500, which is going to control the entire market. So the S&P 500 is composed of 500 companies, but the top 10 companies have the most amount of weight in the index. So seeing what's happening with those big companies like Apple, Google, Amazon, Microsoft, that's important to indicate what's going to happen with the S&P 500 earnings. Because if the biggest companies are reducing earnings, that's going to have the biggest weight on the S&P 500 overall. So there you can start to see some revisions to those S&P 500 estimates. So with that being said, I think we're kind of at a wait and see approach right now. We have some key levels in our head. We can make some estimates now, but really what happens in quarter two with earnings and if we can get inflation under control is very important on where we could find a technical and fundamental bottom or a very good level of entry into the S&P 500. Now, every investor is different. Every investor has different time horizons. So I don't know, or I cannot say what a good entry is for you. All I can do is point out some of the key metrics, some of the things that you should be looking at to make an educated assumption or guess on where you think a potential or near a potential bottom is. And if you get near one, that is going to be really good in the future. Now, if you're looking for a brokerage, you can sign up with Webull. If you use the link down below and you deposit $100, you'll get 6 free stocks valued up to $12,600. Webull charges $0 in commissions in stocks and options, has awesome extended hours trading. You can start trading at 4 a.m. Eastern time to 8 p.m. Eastern time. They also allow you to trade over-the-counter stocks as well. In addition to that, if you want to get trade alerts, for example, what stocks I'm buying and selling right now, what options I am doing, you can join the Patreon. It's $5 a month, In the Patreon, you will get access to the private Discord server. It's on the member activity channel where I notify all members what stocks I'm buying and selling. In addition to that, it's a community where we learn together, grow together. So if you have any questions, you can hit me up on the Discord server as well. Hit that subscribe button, ring that bell, smash that like button. I'll catch you on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.